Everyone. Welcome to today's lesson on one of the most important concepts in accounting, the accounting equation. It's simple. This is the equation: assets equal liabilities plus equity, liabilities for third parties and equity for owners. It's simple, logical, and the foundation of all financial statements. If you understand this, you will understand how businesses track their money. My first video, I will explain about this. My second video, I will give you examples. In simple terms, this equation tells us how a business is financially structured. Let's break it down in an easy way. Think of assets as everything a business owns that has value. This can be things like cash in the bank, buildings, land or equipment, inventory, products a business sells, accounts receivable, money customers owe the business. This is the assets. Let's give a simple example to make it easy for you. Imagine you own a bakery. Your oven, cash, and ingredients you bought for your business, your bakery, are all assets. Because they belong to your business and help it operate. Let's move on to the liabilities. Liabilities, this is what a business owes to others. Stuff that a business owes, that's what I wrote here. Assets, stuff that a business owns, equal stuff that a business owes. Like what liabilities? Like loans from the bank, bills that haven't been paid yet, salaries owed to employees. Let's give an example. If your bakery took a $5,000 loan from the bank to buy an oven, that money is a liability. You need to repay it. When you need to repay it, that means it's a liabilities. Finally, we have equity, which is the owner's share of the business. It's what remains after paying off all liabilities. Here an example. If you started the bakery with $10,000 of your own money, that's your equity. But if you take a loan, part of the money in your business, it's belong to the bank and you have to repay it to the bank. That's mean part of this 10,000 you take. Yani, if you started the bakery, I will make it clear more. If you started the bakery with $10,000, but from your own money, you put 5,000 and you took a loan from the bank, 5,000. One, it's for equity, and the other is the liabilities. It's belong to here. Okay. Continue with me to watch my second video, the example.